Hello, I'm Noelle Lim on ASEAN Speaks by Maybank. As the Fed meets this week, we look at what's in store for rate hikes, inflation behaviour, ESG stock picks, and investment highlights for the new year. Chua Hak Bin, co-head of Macro, speaks to our analysts in this weekly briefing.
Hey, hi, good morning. It's 12 December. Just a quick recap of last week. US markets ended down, with the S&P down more than 3% last week on recession fears and a higher than expected producer price index. But Asian markets ended higher for the week as relaxation to China's zero COVID policy boosted hopes that the world's second largest economy would reopen by early next year. The Hong Kong HSI rose by more than 6% last week. China's Shanghai and Shenzhen stock indices gained by more than 1%. Hang Seng's mainland property index, which tracks some of China's largest property developers, rose 10% on Friday last week as Beijing ended a ban on equity financing and extended 162 billion in loans through state banks. ASEAN markets were, however, down for the week, led by a sell-off in Indonesia, that's down by more than 4% as commodity prices fell. The central banks in Australia, Canada, and India raised their benchmark policy rates last week and warned of more to come. This week, we will have the Fed, European Central Bank, and the Bank of England holding their last policy meeting for the year. We will have Suhaimi later to comment on the Fed and ECB likely moves. Note that the US CPI for November comes out on Tuesday as well, and that will be closely to watch to see how inflation is behaving. Oil prices ended sharply lower last week, with Brent crude oil falling to the lowest levels in a year, even as traders try to assess the impact of latest sanctions on Russia, including a price cap and an EU embargo on seaborne imports of Russian oil. We will have TJ later to comment his views on the oil price outlook for 2023. Today, we have Suhaimi to comment on the Fed and ECB, Jue and Zamros on whether inflation has peaked in ASEAN, Anand on his latest ASEAN strategy and Malaysia's 3Q earnings wrap, Dylan and Anand on the ESG compendium reports on Singapore and Malaysia, TJ on the oil price outlook, Jackie on the year ahead for the Philippine conglomerates, and Yuani on the year ahead for the Thai healthcare sector. So let's kick off first with Suhaimi. The Fed meets this week. What are your expectations for the rate hikes? What else would you be looking for in the Fed statement?
Good morning, everyone. At the upcoming FOMC meeting, there are four things to look out for. First, of course, is on the Fed fund rates, which we expect to be raised by a slower pace of 50 basis points to 4.25%, 4.5% range after the strings of 75 basis point hikes between June and November. Secondly, we expect Fed to revise its guidance on Fed fund rates or the dot plot to indicate a higher terminal rate than the 4.6% previously signaled at the September FOMC. We are penciling in a terminal rate of around 5% to 5.25% to be reached by springs next year, implying the current rate hike cycle to peak by the FOMC meeting in March or May. Third, as usual, for any FOMC meeting at the end of quarter, there will be a review of Fed's forecast on key macroeconomic variables like growth, inflation, and unemployment. And lastly, we also be keeping an eye on Fed's messaging on its balance sheet reduction program, although we expect no change to the current pace of $95 billion per month since September.
So Suhaimi, what about the ECB rate decision on Thursday this week?
On the upcoming ECB monetary policy meeting, I think similar to US Fed, we expect ECB to raise its policy rate by a smaller quantum of 50 basis points after two consecutive round of 75 basis point hikes. This is as recent inflation number came in below expectation and thus slowed for the first time in 1.5 years, but obviously still high at around 10%. We will also keep an eye on the quarterly review of economic forecasts, as that might explain the rate decision and forward guidance, especially amidst the risk of a recession and stubborn inflation. Additionally, ECB policymakers are expected to decide and guide on the strategy on the rollback of its balance sheet, i.e. ECB's version of quantitative tightening.
Thanks, Laimi. Let's bring in Jue and Zamros on how inflation is behaving in ASEAN. Particular inflation data came out for Thailand and Philippines last week. And let's bring in Jue first. In Thailand, inflation appears to have peaked and easing off quite quickly. So Jue, what's driving this drop in inflation in Thailand?
Hi, good morning, everyone. So for Thailand, headline inflation edged down to 5.5% in November. That's the slowest pace in 7 months. And the easing was mainly due to softer food inflation, which came in at a 4-month low of 8.4% compared to close to 10% in October. And that's because of improved supply of food ingredients, especially fruits and vegetables, as well as meat. Prices of fat, oil, and seasonings have also risen by the slowest pace in 15 months because of government price controls on cooking oil and similar products. Core inflation was also steady at 3.2%, unchanged from October. Prices of core categories remain relatively soft. And we expect headline CPI to average 6.1% this year, slightly lower than our previous estimate of 6.3%. And we are looking at 2023 inflation forecast to ease further to 3%. That's in line with the BOT's latest estimate.
Zamros, the opposite seems to be happening in the Philippines. What's driving inflation higher? And will this force the central bank to continue hiking aggressively? I think they're due to meet this week.
Yeah. Morning, Harbin. Morning, everyone. Yeah, the latest print of Philippines inflation shows that the monthly inflation in November still on upward trend at 8% year-on-year in November. That was up from 7.7% in October, which makes the for the first 11 months now inflation at 5.6% year-on-year. Now, if you look at the major CPI basket of the Philippines, the housing and utilities seems to have already reached the peak at 7.4% in October, because it goes down to 6.9% in November. And the same goes for the transport, which is now the latest print at 12.2%, lower than the what it was in July, at 18.1%, which we think that was already reached the peak at that time. But the only item, CPI item, that still not showing a downward trend is the food and non-alcoholic beverages, which already double digit at 10% in November. It was up from 9.4% in October. So we think that the major contribution to the higher food and non-alcoholic beverages is because of the Typhoon Paing and Kading, which hit the Philippines the end of September and early October. And historically, if you look at the historical, the impact of natural disasters is normally pushing up the food prices for it takes about 3 months to reach the peak. Hence, we expect the headline inflation in Philippines to reach the peak in between November this year and January next year. As far as BSP is concerned, we expect BSP to raise 50 basis points this week on Thursday. And we are taking the view that BSP will keep the policy rate unchanged for the whole next year at 5.5% after 350 basis point rate hike in this cycle. But instead, we expect the government to continue to focus with the non-monetary measures, especially to ensure sufficient supply of food. There's already talk that the government is expected to extend the executive orders to maintain lower import tariff, especially on the 4 food items, which is pork, poultry, corn, and rice, and as well as coal. Harbin.
Thanks, Zamros. So Jue, scanning across all the ASEAN 6 countries, which countries have seen inflation peaking or peaked, and which are still facing rising inflation pressures?
Yeah, so inflation seems to have peaked in most of ASEAN, except for the Philippines and Vietnam. In fact, for Thailand, inflation already peaked as early as August at 7.9%, as energy costs moderated from last year's higher base. Malaysia's headline inflation also seemed to have peaked at 4.7% in August and is down to 4% in October. Although for Malaysia, core CPI continues to inch up because of pent-up discretionary spending as well as services demand. And for Malaysia's case, we are looking at inflation at 3% next year, but that would also depend on the new government's policy on subsidies. Indonesia and Singapore saw inflation peaking in September. Indonesia's headline inflation jumped to 6% in September because of the fuel price hike, but has eased to 5.4% as of November as food prices ease. Singapore's headline inflation also peaked at 7.5%, while core CPI at 5.3% in September. They have both eased in October because of softer cost of services, retail, and private transport. But for the other two countries, I think, as Samros mentioned, Philippines inflation is expected to stay elevated because of higher food inflation on disruption from typhoons and the weaker peso in the coming months, while Vietnam's inflation is also still picking up on the back of rising costs of food and housing and construction materials, and will likely stay elevated in early 2023 because of resilient consumer demand from the reopening tailwind, as well as the Lunar New Year in January, as well as the accelerated depreciation in the Vietnamese dong.
Great. Thanks, Jue. Let's bring in Anand. So Anand, on your latest ASEAN strategy, what are the main highlights and themes going into 2023?
ASEAN Plus, we highlight this time around that we have been seeing some profit taking happening in the ASEAN markets, following some pretty good gains over the last couple of weeks. That's really in line with global markets and also the improved sentiment on North Asia. But what's interesting is when you look at the performance chart here on figure 2, you'll see that ASEAN is still outperforming North Asia despite the huge gains we have seen in the Greater China area. So I think this bodes well. You'll see our heads of research still have quite sizable upsides for their respective markets. For Malaysia, we'll be updating our target price for the index next week. Well, later this week, actually, when we publish our 2023 outlook. But generally, quite a positive view. And I think this is rooted in a couple of things. Most importantly, corporate earnings delivery has been quite strong. And you saw that in the 3Q numbers as well. And the other thing is, I think when we look at the GDP outlook, as has been covered by the macro team, it will be a picture of resilience in ASEAN in 2023. And that's good because even though we are at some risk of capital outflows from the region, we saw some of this in Indonesia over the last 2 weeks, rotating out of Indonesia into North Asia. Dramatic outflows, probably unlikely given that foreign ownership is not really that high to begin with in the region, despite some inflows in 2022. And generally, we do have some attractions as well. If China reopens, I think it was pointed out that commodities might do better than expected, and that'll be good for certain ASEAN markets like Malaysia and Indonesia. So yes, some risk of capital outflows, but generally, ASEAN still cheap, strong earnings, relatively stable politics, and certain areas of attraction like the commodities exposures in specific countries like Malaysia and Indonesia. I think for the last 2 weeks, we have been still doing some upgrades in certain sectors. And this is mostly around Thailand, where we've raised the Thai telcos to positive and rated our neutral on Thai healthcare. I think those are the 2 key sort of sector updates for the last 2 weeks.
What about changes and specific top calls for top buys and sells?
So in Malaysia, we replaced one of our top buys, Petronas Chemicals, which we downgraded to hold because of the weakening product price outlook for their product base, and put in Yinson. Just to remind listeners, Yinson is an oil and gas play, an FPSO, and it just looks to have secured another contract in Angola. But beyond that, Yinson is also the top scoring stock in our ESG scoring in Malaysia, which you can read about in our ESG compendium, which was published at the end of November. So, Yinson, we think, has a lot of potential. So that goes into our top 3 picks. I think for Singapore, the Singapore ESG compendium was published last week. Lots of great data in there. You'll notice that we've reiterated our buy call on the 3 Singapore banks because of their strong ESG commitments and thematics. So that's definitely something we are reiterating going into 2023. Elsewhere, in terms of specific stock changes in the last 2 weeks, the Philippines is where we've seen some changes. We've downgraded AC Energy, primarily because it's done so well. The share price has gone up so much. And we would say, switch into APPM, Abuit's Power, for similar earnings growth, but at lower valuations.
So Anand, on the Malaysian results run up for the 3rd quarter, Did earnings meet your expectations, and which sectors are outperforming and which fell short?
Yeah, I think it was slightly ahead, actually. I mean, we probably should have taken the cue from extremely strong 3Q GDP numbers, up double digits, 14% year on year, to sort of correlate to strong earnings delivery. But we're always very cautious about that in Malaysia because historically, the correlation between GDP growth and earnings growth relatively weak. But in the third quarter, it was actually quite good. So the earnings did come in ahead of our expectations. I think some sectors which were reopening focused, like consumer and property and construction, and REITs as well, actually, did come in better than expected. The banks, mostly in line and some above. But what struck us about the banks is the confidence they are showing. We've seen across the board, we've seen upgrades in guidance for loan growth, for net interest margins, as well as credit costs. So the outlook for banks into 2023 remains quite robust, even though we are looking at interest rates peaking in the first quarter or first half of the year. So I think where I would focus is really the recovery place, especially consumer. Also banks, given the guidance is solid and fundamentals are solid. And the third is tech. Yeah, so tech, I think if you're looking at rates sort of starting to decelerate in the US, tech is looking very attractive at current levels versus historical.
So Anand, if I have to push you on the top Malaysian names picks for next year, can you name us a few?
Yeah, sure. So for the banks, we'll stick with RHB, Hong Leong Bank and Alliance. Hong Leong Bank is our top quality pick, but RHB is a good balance of quality as well as yield. So that stock will give you 5-6% cash yield. And Alliance, which is a smaller bank, but good yielder and extremely sensitive to rate increases, given its CASA base is almost 50% of deposits. So those three banks, I think, should be the core of any bank's portfolio. I think for consumer, we have a range of picks, Mr. DIY, Berjaya Food, Leong Hub, Aeon. So I think those which should be part of the portfolio. Leong Hub was recently upgraded in the third quarter reporting. And for tech, Inari is one of our three top picks for the market, as you can see. But we also recently upgraded Great Tech, which has EV and solar exposure, quite rare in Malaysia. Also, Frontcan and Vitrox have been in our buy list for a long time, and we have no problem maintaining them in our buy list. Just two more in the electronics manufacturing services space, which is a subsector of tech. We recently upgraded VSI to buy, so that's back on our buy list, and we maintain our buy on A-Tech or Aurelius Tech. Yeah.
Great, thanks, Anand. Dylan, excellent 132-page ESG report on Singapore's transition island. Can you share with us the key highlights and themes?
Thanks, Agbin. I think in our compendium, we took the path of looking at Singapore's low carbon transition through the lens of gaps. We found three. Number one, an energy gap, where Singapore is hitting a ceiling in terms of energy decarbonization because of its dependence on fossil fuels for electricity. Number two, a corporate gap, where the large caps are leading net zero commitments and implementation, whereas the small and the medium caps are falling behind. And number three is a perception gap. There's a big differing view of what the companies are saying they're doing versus what the public believes that they're doing on ESG. Indeed, when we look at these gaps, there are opportunities. In fact, we've seen Singapore implementing their green plan to drive a policy mix towards alternative energy, hydrogen, carbon taxes, and they've also increased a regulatory push towards transparent disclosures, as well as driving the green economy. When we compare against our last ESG compendium we did, and that was 18 months ago, Singapore has made some very significant progress, especially with its 2050 net zero target. So this can continue to attract a lot more green investments into Singapore, but there's a lot more work to be done.
So what were your top 5, say, Singapore ESG stock picks?
I've actually got 10, not 5. All of them are linked to ESG
fine.
themes, and also looking at how they can implement the transition. And these are Capital and Investments, CICT, Comfort Delgro, DBS, Keppel REIT, Netlink, OCBC, Semcorp, UMS, as well as UOB.
Great, thanks, Dylan. On the same ESG theme, Anand has also released a 155-page report on Malaysia, shifting into high gear. So Anand, can you share the key highlights and themes?
As Dylan pointed out, the last time we did ESG compendiums was 18 months ago. And compared to that, for Malaysia as well, we've seen some significant progress across the board. But I would say mostly at the government and regulatory level. I mean, for the government, we've really sort of seen a switch from I don't really care at all to I do care a lot and I want to show the world I care kind of branding for Malaysia. And this was done most aggressively by updating their NDC target to unconditional 45% from unconditional 35% before, plus conditional 10%. And beyond that, we've raised our targets for renewable energy penetration rates in the next 10 years. Also, EV usage as well has got a lot more attention now in terms of the targets for how we want to advance that industry. So I think the regulators appear to be on the right track as well. The government appears to be on the right track, but the hard work is still being done mostly by the regulators. So Bursa, SC in terms of financing for green projects. Also Bank Negara, which works with the SC in terms of climate reporting for financial institutions, especially the banks. So all that is moving very quickly if you read the report. But the two most impactful for you as an investor would be Bursa's enhanced sustainability reporting requirements, the ESRR and the VCM. So the ESRR basically says in the next 3 years, all listed companies have to come up with similar data on sustainability issues, and that's in the report if you want the details. But the point is, finally, before it was a dog's breakfast, but now we can actually compare like with like in terms of all the companies reporting similar data points. So we can actually see where all companies stand much more easily than what it is now, which is a very sort of a hodge of data releases. And the VCM, which was officially launched last week, that's the pathway to emissions trading in Malaysia. So Bursa has taken the first step. We would expect the government to push forward with things like emission trading and carbon tax in the next 1 to 2 years as well. Finally, corporates, still not great. We're seeing a lot of progress on the E side by GLCs like Petronas and Tenaga, but as issues relating to foreign labor remain a vulnerability for many corporates, and no chart highlights that vulnerability better than this one. So Atta IMS, as soon as it was implicated in foreign labor abuse, share price has fallen and made it a penny stock, never recovered. These kind of issues, we think, are still potentially a risk in given lack of top-down or organized sort of a response to foreign labor treatment issues. Sorry, you're going to ask me about topics, right?
Yep, that's right.
Yeah. All right. Yeah, so we have our usual general portfolio picks on the right here. But what's important is from here, these are the 15 picks in Malaysia. So we always look at Singapore and we want to do 50% better. So Dylan has 10 picks, I have 15. And these are based both in terms of Sustainalytics filters to make sure that Sustainalytics is also comfortable with them on their scoring. But importantly, it's also based on our scoring, which is the second last column, MIBG ESG score. And you can read about those scorings in the back where all the sectors are, all the test sheets with the scoring are shown as to why we've picked these 15 stocks to be part of our ESG portfolio.
Great, thanks.
Okay, thanks.
Let's move on to TJ. Oil prices had the biggest weekly fall in months on growing recession fears, and despite hopes for a China reopening. Brent crude fell by about 5% last week to $76. So what's your forecast for next year? And why do you expect the oil market to remain strong in 2023?
Yeah, hi, morning everybody. To put it short, I think for us, we think the oil price will remain strong in 2023. Our forecast remains at $100 per barrel dated Brent. Reason being is pretty simple. Demand is picking up again. The China factor is coming up once the economy recovers. Secondly, in terms of supply, we have not seen any new supplies coming in or new fuels coming into production. Second, And thirdly, we still see that the OPEC Plus pack remains pretty strong, very disciplined. I think they are a swing producer. They will basically go for high price over higher output. So that's where they could dictate supply and also ensure that oil price remains high.
So TJ, what would be your top 3 Malaysian oil and gas stocks for next year?
For next year, we like Yinsen. Like Anand has pointed out, they have both the oil play as well as the ESG plays. That is one. Secondly, we like Hibiscus. They are the alpha play for rising energy price. Thirdly, we like companies like Wasiong for small mid caps, whereby we are seeing a recovery in terms of earnings as well as expansion in margins.
Great, thanks, TJ. Jackie, on your year ahead for the Philippine conglomerates, what's the outlook for next year and why are you recommending to go with the giants?
Hi, good morning. So the market appears to be looking for good quality earnings growth. And by that, we mean more resilient multi-year and more importantly, the growth that is hedged against inflation and peso depreciation. As such, for 2023, we expect the uptrend in macroeconomic data to be more to be the main catalyst for the conglomerate sector. Sounds unexciting, and any macroeconomic data improvement anyway is going to already boost the NAV of all the conglomerates. But I look at it more as a going back to basics, to the fundamentals of the Philippine economy, which is domestic consumption, which is boosted by mobility.
And which conglomerates would be your top picks?
So SM and GT Capital remain to be our top pick. SM is definitely our preferred consumption positioning. Not only is it a huge player in the essentials consumption space, which we know from 2018 will remain resilient against inflation, but it has strong pricing pass-through mechanisms arising not only from the various market leadership it holds, but also in the inherent retail and mall-based exposures. GD Capital is our second pick, largely due to its Toyota business, also the market leader in the auto industry here in the Philippines, which also lends to a degree of pricing power.
Great, thanks, Jackie. Let's bring in Yuwani. On your year ahead for the Thai healthcare sector, which has actually done pretty well this year with the reopening, will the growth be sustained into 2023?
Yes, good morning. We think the medical tourism rebounded since November 21 reopening and has been strong throughout this year. However, we don't think the pent-up demand will be sustained in 2023, as we think it will end around of second quarter next year, based on Bumrungrad management's guidance.
Why are they guiding for the lower growth for next year? Sorry.
Well, we have seen strong revenue from international patients, which surged to more than pre-COVID level since the second quarter of this year. And they think that, the pent-up demand that has been around for 2 years will not last. So it's unusual that the revenue surged above pre-COVID level by 24% in the third quarter, and they think it will not last.
Are the China tourists a big share of the patients in some of these hospitals?
Well, less than 1%.
Let's see. Okay. So, Yona, which Thai healthcare names would be your topics for next year?
One is CSG for its good long-term growth in the Eastern Economic Corridor, Thailand Industrial Hub, and all of its 9 hospitals are there. So it will be a prime beneficiary for the long-term good growth there. And the second one is Mega for the good long-term outlook from the strong brands recognized in fast-growing ASEAN, where it earns about 80% of its revenues.
Okay, thanks, Yohani. Have a good week ahead.
For more information, speak to your trading rep or check out Maybank's research reports on the Maybank Trade app. Follow us on Spotify, Apple Podcasts or Google Podcasts. I'm Noel Lim on ASEAN Speaks by Maybank.